By the time most traders recognize a trend has flipped, the move is already gone. The real edge isn't reacting to the shift, it's reading it as it forms. That's exactly what change of character lets you do. Spot the moment buyers quietly lose control to sellers, or the reverse, before it becomes obvious on the chart. Welcome to the ComLucro channel. In this masterclass, you'll learn how CHoCH fits into smart money concepts and ICT, why liquidity is the real fuel behind every reversal, and how to use it to make sharper, more disciplined trading decisions with real structure and confidence. So, if this kind of content helps you, take a second to like the video, subscribe, and turn on notifications so the next lessons reach you the moment they go live. And feel free to share in the comments which topics you would like us to explore in future videos. And if you want to support the channel on a deeper level, consider becoming a member to unlock exclusive content and help keep these lessons coming. You'll also find links to our trusted partners in the description below. Using them costs you nothing, and it directly helps the channel keep producing free educational content like this. Now let's begin. What is a change of character in smart money concepts? A change of character, or CHoCH, is the first sign that the side in control is losing its grip. The dominant momentum starts to fade, and order flow begins to turn, buyers handing control to sellers, or the other way around. On the chart, it shows up as a break in the most recent structure, the market's first real hint that the environment is about to change. So, how do we identify a valid change of character in the market? In a bearish scenario, a change of character takes place when price breaks and closes below the most recent major low and the latest demand zone. For example, when price is in an uptrend, consistently forming bullish structure breaks. A shift occurs when it breaks through the most recent major low within the demand zone, signaling the first change of character. The downward momentum then continues as price pushes through the next demand zone and higher low, resulting in a second change of character. This dual change of character suggests an impending shift in market structure. At this point, we can anticipate price entering a bearish order flow. Consider this crucial point. Every time a zone breaks, an opposite side zone automatically forms. Since price has broken several demand zones, a supply zone has been created at the extreme. So, our expectation is for price to push higher toward that extreme supply zone. If price reacts from this area, we can look for sell opportunities, anticipating successive bearish breaks of structure to the downside. To understand why this happens, hold on to one principle. Price moves from one pool of liquidity to the next. That liquidity builds up wherever orders cluster, above highs, below lows, around equal highs and equal lows, along trend lines, and at every level where traders park their stop losses and pending orders. Put simply, the market needs liquidity to move, and those clusters of orders are the fuel behind every major shift in direction. We already have a specific lesson on liquidity, buy-side liquidity, sell-side liquidity, and static liquidity, so I will leave the link in the card and also in the description below. For this video, the most important idea is this: when price takes liquidity and then breaks structure, that movement can confirm the shift we identify as a change of character. Looking at the chart, we can see that after tapping into the higher timeframe supply zone, price pushed lower and formed the change of character wave by breaking two higher lows. This showed that the bullish structure was starting to fail. After that, price pulled back, mitigated the newly created supply zone, reversed direction, and pushed lower again, breaking through structure and closing below the newly formed lower low. Subsequently, price created another pullback, moved back into another supply zone, reacted from that area, and continued lower, breaking another structure. It is evident that the market's overall bullish structure has changed to bearish after the formation of the change of character pattern, and the price entered the bearish order flow phase. So, a change of character involves changing the market's overall trend from bearish to bullish, or from bullish to bearish. Let's consider another market structure where the price has formed a change of character by breaking and closing above a major high. Additionally, we see that the price breaks through this supply zone. It's noteworthy that the price has not left any unmitigated supply behind. As you can see, all the supply zones have been mitigated. This means that as the price breaks through the latest supply zone, it signifies the formation of a demand zone. As mentioned earlier, whenever a zone breaks, an opposite side zone is automatically formed. Therefore, a newly generated unmitigated demand zone emerges at the extreme. Considering this, entering a long position based on this demand zone is a viable option. There is a high probability that the price will return to this demand zone, react to it, and then change its direction to the upside. This expectation is supported by the prior formation of a bullish change of character, indicating an upcoming shift in the market structure towards a bullish trend. In this situation, the price has a great opportunity to retrace back down, touch our newly generated demand zone, activate our pending buy order, and then push to the upside. Now let's get into the criteria that separate a valid, high-quality change of character from a false one, and how to use each to your advantage. The first criterion is higher time frame mitigation. A change of character is valid only if the price reverses and originates from a higher time frame supply or demand zone before breaking the recent major structure and initiating the change of character. If the price creates a change of character without interacting with a supply or demand zone, even with a valid candlestick pattern, it cannot be considered a valid change of character. This is crucial because it helps us identify high probability points of interest and valid reversal patterns, preventing us from falling into traps caused by false reversals and trading in the wrong direction. For example, consider a bearish market structure where sellers are in control. The price has formed a series of bearish breaks of structure and supply zones associated with these structure breaks. In the following scenario, price gives a tiny rejection from the last supply zone, then pushes up and closes above it. This is a trap that plays out in the market all the time. Traders who haven't read the structure correctly see this move and call it a change of character, a signal that the trend is reversing. Convinced the bearish phase is over, they go long off the newly formed demand zone and tuck their stop loss just below it. But instead of reversing, price makes one brief push up, mitigates the supply above, and then resumes its move down. Their stops get taken out, and most never understand why, so they make the same mistake again and again. Here's what they missed. Price never reversed from an unmitigated demand zone. There was no reason to go long until price reached a major unmitigated demand area. The change of character was invalid. That upward move only existed to mitigate the supply above, using the last supply zone as inducement to sweep liquidity and build momentum for the move down. Without a real grasp of market structure, losses like this are almost guaranteed. With it, the trap is obvious. The change of character was invalid because price hadn't reached the higher time frame demand zone yet. This scenario highlights that without a proper understanding of market structure, you're likely to experience losses. Inexperienced traders could have avoided this if they had a better understanding of market sentiment. They would have noticed that their identified change of character was not valid because the price hadn't reached the higher time frame demand zone yet. The second criterion adds another layer of confluence, the liquidity sweep. To obtain additional confirmation in identifying high-quality change of character patterns indicating an upcoming market structure shift, we should wait for the price to establish static liquidity zones near our identified higher time frame area of interest. We fully discussed static liquidity zones and their various types and models in the market in detail in our previous episodes. I strongly recommend watching those episodes carefully if you want to have a solid grasp of static liquidity zones and understand their profound impact on market price direction. However, let's have a quick breakdown of them here. As you know, static liquidity refers to the specific zones in the market where a large pool of money is resting, such as stop losses, buy or sell orders, and can also be found in various areas on the price chart. When we talk about static liquidity, there are a few patterns that show up all the time in the market, and they're super practical to spot. I'm talking about things like equal lows, equal highs, and dynamic trend lines. Each of these fits into some classic chart formations you've probably seen before, like double bottoms, double tops, sometimes even triple tops or bottoms. And of course, those bullish or bearish trend lines that everyone draws. Now, picture this. We're looking at a higher time frame, say the 15-minute chart. Price is clearly in a downtrend, and you can see it breaking structure to the downside again and again, forming those BOS, breaks of structure. After tapping into the previous supply zone, the price reversed and created an unmitigated supply zone awaiting mitigation. Now, the price is pushing to the upside. Zooming into a lower time frame, like the 1-minute time frame, we see that the price has formed a series of higher highs and higher lows on its path toward the 15-minute time frame supply zone. Just before tapping into the supply zone, and right below it, the price created equal highs, forming a double top that accumulates great liquidity near our identified higher time frame supply zone. We see that the price sweeps the liquidity accumulated above the double tops, taps into the higher time frame supply zone, reverses its direction after mitigating the 15-minute supply zone, pushes downward, and creates a change of character by breaking and closing below the most recent major low, eventually breaking through this demand zone formed by the break of structure. As mentioned earlier, every time a zone breaks, an opposite side zone automatically forms. Since the price broke through the latest bullish demand zone, it has formed a supply zone right here, associated with the change of character's bearish wave. So, here we have the confluence factors that we were looking for to identify a high-quality change of character pattern that provides a high probability in the market. After mitigating the higher time frame supply zone and conducting a liquidity sweep in the current time frame, a change of character formation occurs. In the next step, we can place a sell limit order at the lowest point of the newly generated supply zone, setting the stop loss a few pips above the highest point of the zone. For the take profit, we can either set it at the unmitigated demand zone of the higher time frame or target the current time frame swing low. Recognizing a liquidity sweep pattern before the price reaches our identified area of interest is crucial. This pattern confirms the strength of our supply-demand area. We use liquidity sweeps as a confirmation factor. The idea is simple. The market requires liquidity for momentum. If the price doesn't sweep liquidity before a key level, it often uses that zone as liquidity to fuel its momentum. As a result, if the price taps into a higher time frame supply or demand zone without sweeping liquidity and subsequently shows a rejection, then also creates a change of character pattern on the lower time frame, there is a high chance that the price will continue moving in the opposite direction of the newly generated change of character. This can also trigger stop losses of traders who entered the market, expecting that the price would change its primary direction after the emergence of the change of character pattern. The third criterion is the double zone breakout. For a change of character pattern to be more effective with a higher chance of success, the price should break and close below or above two successive supply or demand zones along its path. For example, in this scenario, if the price breaks through this demand zone, we have a double zone breakout, because the price breaks out of two successive demand zones with a bearish single leg movement. This pattern will be a strong confluence and confirmation for entering the market by opening short or long positions, depending on the bearish or bullish order flow. Let's consider a scenario where the price only created this supply zone. The price broke through and closed below the two demand zones, leaving a significant inefficiency behind. This provides a strong confirmation after the emergence of the double zone breakout. Subsequently, a newly generated strong supply zone forms at the extreme. In this case, we can place a sell limit order at the extreme demand zone because the price has a great chance to return, fill the inefficiency left, fulfill the orders, tap into the order block, mitigate the supply zone, and then push to the downside. Considering the concept of a double zone breakout, or even multiple zone breakouts, in your trading will enhance your confidence in your trading journey, making you more certain about your trades. Now let's explore another possible scenario of a double zone breakout that you might frequently encounter in the market. Once again, we have the same scenario with only one difference. The price couldn't break through the second demand zone with a single downside movement. We see that the price broke through the last demand zone and created this supply zone at the extreme. Then, the price experienced a temporary pause and a pullback, but it couldn't mitigate the extreme supply zone. Instead, it formed a liquidity pool by creating a double top. Subsequently, the price pushed to the downside and broke out of the next demand zone. Since a demand zone has been broken, a new opposite side zone will be created, which is this supply zone. As mentioned earlier, the upper supply zone is the extreme one, and the second supply zone, located a bit lower, is called the decisional zone. Please consider that we cannot place any trades based on the decisional supply zone, because there is a high chance that the price will push higher to sweep the liquidity accumulated above the double tops and trigger the stop loss of traders who entered from the decisional supply zone. If you had entered the market from the decisional supply zone, there is a high chance that the price will push higher to mitigate the extreme zone and also sweep the liquidity accumulated along its way. If you had an order, you would be part of that liquidity. What we should do is wait for the price to sweep the liquidity accumulated in the market, tap into our extreme supply zone, and then we can enter the market. To wrap up, mastering the concept of change of character is essential if you want to stay ahead of market shifts and avoid getting caught in traps. So, trader, if this video brought you more clarity, like it, subscribe, and turn on notifications so the next lessons reach you. And tell me in the comments what you want me to cover next. And if you want to go deeper, you can become a member of the ComLucro trader community right here on YouTube. It unlocks exclusive content, early access, and extra tools for your development, while directly supporting the channel. You'll also find our trusted partners linked in the description. Using those links costs you nothing and helps us keep producing this kind of educational content. And remember, the mission of the ComLucro channel is simple. We help traders build clarity, confidence, and structure, so every decision is made with discipline and intention. Here you'll find complete courses built as a true trading masterclass. Liquidity, market structure, higher time frame analysis, and supply and demand. Always focused on reading price and executing with a professional mindset. We also cover trading psychology, risk management, and long-term consistency. Because trading isn't just about charts, it's about mindset, discipline, and execution over time. Our main courses include smart money concepts, ICT, technical analysis, trading psychology, and Wyckoff. Alongside that, we share insights from respected traders whose work helps you understand how markets really behave. Thanks for watching, and I'll see you in the next video.